Hello everyone, welcome to the analyst classroom. Today we are going to learn about the and balance sheet. So in the first learning elements of the balance sheet, there are types of balance sheet. There are two types of balance sheet, vertical and horizontal. Vertical means this, you will see this type of balance sheet in most of the financial reports. So the vertical balance sheet start with the equity and below is the liability, and it gives the total of the equity and liability side, and then comes the asset and his total, and the total will be tally as the rule of the balance sheet. And here is the horizontal format of the balance sheet. Right hand side is the asset and left hand side is the equity and liability. So basically equity and the liability side components are called as the sources of funds, and this is the application of funds. Sources means from where the company gets the money, for example from the equity, from the retained earnings or loans, and where it gets the where it uses those money are the calls the application of the fund. uh, prof- uh, Property, plant, equipment, inventory, and other things where he invests the money or spends the money. And then comes to the second learning about the uses and limitation of the balance sheet. So first use case is the, it shows the liquidity of the liquidity of the firm by current ratio, current asset divided by current liability. It shows the current ratio. Then the acid test ratio, current asset minus inventory divided by current liability, and the cash ratio, cash divided by current liability. These ratios shows the liquidity of the balance sheet, liquidity of the firm, and then solvency of the firm is defined by the financial leverage. Financial leverage formula is the asset divided by equity, or 1 plus total debt divided by equity. If financial leverage is a 1 or less than 1, it's good. Financial leverage is 1, it means no debt. And if the financial leverage is greater than 1, means larger the debt. Suppose if debt will increase, if here is the debt will increase, then the financial leverage ratio then the equity will be lower, and the equity will be lower, then the asset will be, and the formula and the financial leverage will increase. Suppose asset is equal to equity and liability, and if the asset is higher, if liability is higher, then the equity will be lower, then the equity is lower, then the financial leverage ratio will be increase, because asset will be the same and the liability will down, and the liability equity will be down, and then it's increase the financial leverage ratio. So the financial leverage should be lower is better. Now main main motive of the balance sheet is and shows the ability to make distribution to sh- shareholders. Company's balance sheet shows how much company's ability is to make distribution to the shareholders. Then let's talk about the limitation. In the limitations, balance sheet's assets are the measurement Measurement base means asset on the balance sheet are shown on the fair value or the acquired value minus accumulated amortization or depreciation, not shown the internal generated goodwill. This is another topic. So the basically asset and the liability are shown on the fair value, not the market value, and acquired cost. Suppose I own a building and its market price is 1 crore right now, but I have shown this as a 50 lakhs only as a acquired cost or fair value of another asset. His market value is different than the fair value. This is the limitation, and also in internal generated goodwill is not shown. So you have a brand of a 15 or 20 years, and this asset you can't uh, you can't show in your balance sheet. And the another is the pension and other liabilities towards employee might not be properly calculated. Liabilities not not properly calculated, and contingent claims also not properly calculated, like pension. So this is the limitations, and now let's move to the how components of the balance sheet are shown. So there is the method of classified balance sheet used in the US GAAP and IFRS both is group the assets and liabilities together, like like current assets and non-current assets as liabilities or current liability or non-current liability. And another is the liquidity base. Liquidity base is only approved by the IFRS. So assets and liabilities will be shown in under of liquidity means balance in the balance sheet most liquid to most to least liquid. Like the cash will be shown in the first to the PP last. This is the most liquid to liquid, and this is mostly used by and this is mostly used by the mostly used by banks and financial firms. This is the class, classification of the components. And now we will talk about the what is the definition of the current and non-current assets or liability. So so current assets liability means assets slash liability which converts to cash in 1 year or one operating cycle, whichever is longer. Ever is longer is treated as current asset. For example, your inventory is converted in less than 1 year. Uh, so it's a current liability. Or if you are in another business of the shipbuilding or another thing where your operating cycle is greater than 1 year, for example 2.5 years or 1.5 years, then if you are building a ship in a 2.5 year, then that will be your current operating cycle. Your asset will be shown um, in the balance sheet as a current liabilities if it gets converted in more than 1 year also. So your it's defined by the operating cycle or less than 1 year. And what cost is included in the inventory or not. So let's now talk about the included in inventory cost. So it is the purchase cost, conversion cost, and other cost other cost necessary to bring inventory it's in process in its present location or condition. In present condition or location. uh, it basically costs that are necessary to bring the inventory to its present location or condition. It's included. And the excluded is your abnormal loss, normal loss, including material, labor, and manufacturing overhead, and storage cost, storage cost, unless unless regular, unless they are necessary part of, unless they are necessary or part of the production process, part of production process, and the administrative overhead also. Administrative overhead and selling cost. These are costs which should be excluded from the inventory cost, and these are the included in the inventory cost. Okay, this is the basic understanding of the balance sheet and its components. Thank you for listening. If you have any query or suggestion, please leave a comment below. Have a good day.